Oh, hi everyone, it's Susie again from Esoteric Trading Solutions. Hope you're well, looking after yourself, being kind to yourself, your family and friends, being kind to your dogs, your pretty cats, being kind to the world in general, and being kind to even strangers in the world and the environment and the fauna. Just another video I wanted to do because it really captured my imagination, this report by Coinfin, and I think it's a really good one. And it talks about macro and equity themes for the last decade in 10 charts. And I really like this, so I thought I'd present this. As you know, I have to do a video, I have to be inspired by it, but I thought this was a particularly good one by Coinfin, and the fellow's name is Rob, and I have to say I really liked it. He basically went over the last decade, looking from 2010 to 2020, and came up with some really interesting figures. Basically said that many investors fear the imminent collapse of the economic system and that asset prices would crash. And luckily in the last 10 years, all we've seen in terms of equity markets is markets go through the roof, higher and higher and higher. So really very interesting. These charts are from Coinfin. I do use their charts. I don't get paid from Coinfin or anything, but I think it's a terrific package, and I look at this myself. So pretty much what they're looking at, they looked at the S&P, and this is the log scale, and basically looked at from 2010 right through to now. And you know, obviously in 2011 there was the Greek debt trouble, which hasn't really changed at all. Greece has still got massive amount of debt, and obviously the European Central Bank has set down a lot of provisions that Greece has to abide by in terms of their balance sheet, how much they can grow their balance sheet, how much they can spend to ensure they pay back all the debt that they've borrowed in terms of, you know, from the European Central Bank and from investors. Greece is still in a lot of trouble. There's no growth. They can't pay their nurses. They can't pay anyone that works for the government and that sort of thing. So they're doing it very, very hard. But also Bernanke in 2011 started quantitative easing and pretty much put money into the system and reduced interest rates quite dramatically to make it a lot easier in terms of the economic growth. Then we saw Europe come into the fray with their own quantitative easing. We saw the European debt crisis and the US debt downgrade in August 2012. Then we saw the Chinese slowdown in 2015. Oil declined from $110 to $45. High yield worries in the energy space, so high yield wasn't doing so bad. The VIX volatility index actually rose. The VIX spiked to 40, which is quite high. At the moment it's around 10 and around all-time lows. Donald Trump was elected in 2016 as president, and then again we had recession fears. The market came down a little bit, and now we're on a boom again, and interest rates are at all-time lows. Notwithstanding, as we've said before, interest rate yields are rising. So, and also emerging market debt spreads are now starting to underperform as well. So, and we've also seen currency, emerging market debt currency underperform, and also relatively US dollar strength, of course, to emerging market debt currency as well. And I think it's a very interesting article, this one. So obviously 10 years ago there was huge, you know, turbulence because the 2008 crisis happened, of course. 2009 equity markets were on their all-time knees. The Dow was down at 5,400. Now we see a Dow heading towards 30,000. The European situation was very bad, and it still is very bad, I have to say. Greece, Spain, Portugal they still have massive debt, and I'll also add to that Italy. Italy has massive debt, and I've said it before, Italy is the third largest bond market in the world, and they have a lot of problem paying back their debt as well. The US also dealt with an anemic business and consumer confidence, and so, you know, the taps were put on in terms of quantitative easing by the Fed and the European Central Bank, which launched their monetary stimulus policy by issuing obviously issuing more money, but also buying bonds out of the market and giving fund managers and everyone money. So putting money into the system, and so the Fed, and reduced interest rates quite dramatically. So monetary support was everywhere. It wasn't just in Europe the US, but it was also in Asia, and it was also in Australia at the same time. Obviously, the central banks of the world believe that there's no meaningful inflation. I don't agree with that. I think there is inflation in the system. They're just not measuring it properly and not measuring it at all. To me, inflation has gone up, no matter what you look at. If we look at white goods, inflation hasn't gone up, the washing machine hasn't gone up, but certainly everything else seems to have gone up quite dramatically. Then they've got this chart, global growth was led by US emerging markets, and we see that. And obviously growth has been quite good in the US since 2010, up 42%, if these figures from Coifin are right. Europe has been still anemic at 6%. Chinese growth been at 73%. Japan's always had problems with growth, -5%, the UK 18%, India 106%. And don't forget, India have over 1 billion people, so that's significant. And China has 1.4 billion people. Brazil's up 12%. Surprised to see, obviously Canada was 24%, Russia 35%, and South Korea 79%, which is pretty amazing. So looking at GDP in terms of that growth. So obviously growth was very good since 2010 because they did everything in terms of the economic system to try and encourage growth. Obviously reducing corporate taxes in the US, for example, reducing interest rates to all-time lows. Interest rates got to negative along the curve, and also increased quantitative easing by putting heaps of money into the system by buying bonds, corporate paper, high yield paper, that sort of thing, and reducing interest rates quite substantially. So GDP growth has been quite high since since 2010, and essentially India, as they say, was up 106%, which is massive. Say Brazil and Russia was quite modest, and possibly going forward in the next decade we might see those growth figures potentially come off, one would assume. But when you look at the US equity market, it's staggering, I have to say, absolutely staggering. The SPY is up, if these figures are correct, 242% over 10 years. The REITs market, which is the real estate market, in terms of REITs funds, is up 178%. This is the green. High yield debt is up 82%. Bonds are up 43%. Gold's up 30%. Emerging market equities are up 30%. Cash just 4%, of course, and commodities are down 31%. Now, what's interesting about commodities is generally when the market does well, and obviously, if the equity market is doing well, you'd expect the economy to doing well. Generally, when the economy does well, you'd expect commodities to do well, because obviously there's industrial production and things are being, more things are being made, then you generally see that commodities are actually rising. But clearly in the US, as most economists would say, the US is a service economy, and 70% of US economy is basically service. So obviously even globally, commodities have come down quite substantially, and they're down 31% over that time. And you can start seeing from, say, 2014, they kept coming down, 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 down. So even with growth globally, commodities were still coming down, which is very surprising indeed. One would expect, generally in history gone by, that commodities should be going up with growth in economies, particularly emerging market debt economies like India and the Chinese economy, because they're doing infrastructure, building roads and building airports and all sorts of things which use commodities. So it's very surprising to see commodities down as much as that in the last 10 years. Basically, the best performing asset class in the last decade, as they say, is the S&P, 3 times increase including dividends, and the worst performing asset class is commodities, as we see. They then look at the tech and consumer dominated equities, and they look at energy and materials lagged. Discretionary is up a whopping 370%. Technology in terms of equities is up 346%. Healthcare 279, industrial 254, S&P 241, staples 207. And then if we get down to communications, only 5, energy 33, and real estate 46, and telecom 88%. But the returns are absolutely massive for equities, 370% over a 10-year period. Incredible, absolutely incredible. Basically, some markets did very, significantly better than others, but the worst performing market was the energy sector compared to other markets, thus being, the discretionary and technology up 370, 346% respectively. Pretty amazing stuff when I look at this, I have to say. Then they look at basically factors, growth trounces value, and a lot of fund managers will manage a portfolio on a growth perspective or a momentum perspective, on a small cap perspective or a volatility or a value manager. If you're a value manager in terms of portfolio management, for example, if the stock gets cheap, you buy it because it's just cheap, you would have lost a lot of money. The index is down like 14% over the last 10 years. Growth's up 14%. Momentum's up pretty much the same. Small cap is down, negative 0.76, and low volatility is down 1%, which is pretty amazing in itself, okay? So you would have not done so well if you're in a value type portfolio management investment style, but you would have done very well if you're in a growth or momentum investment style manager. Then they look at the larger stocks in 2010 versus now. And in 2010, the largest stock around was PetroChina. It was an energy stock. ExxonMobil was up there, Microsoft, Walmart, Industrial Commercial Bank of China. Things have changed quite a lot since 2010. Apple and Microsoft are up there, technology, Google, JP Morgan are up there, Walmart's down further, and these PetroChina and Exxon are all lower, which is very, very interesting indeed. If we look at the 20 largest stocks now in 2020, surprisingly we find Saudi Arabian Oil Company up there, being the highest, with obviously, I'm assuming this is in terms of market cap, which it is. Apple's up there, Microsoft is up there, Alphabet is up there, which is Google, the old new name Alphabet was Google, Amazon's up there, Facebook, Berkshire Hathaway, Warren Buffett's up there with his company, Alibaba's in there, which is a new entry, of course. And then, obviously we see some of the lesser companies have gone down, like Walmart was up here, which is disappointing, obviously, for Walmart. So very interesting in terms of that. Relative to the start of the decade, tech companies dominated the 20th largest list. Apple and obviously Microsoft were the first companies to have a market cap of over $1 trillion, which is absolutely incredible, I have to say. And then Saudi Aramco came in December 2019 with a valuation of about $2 trillion. Wow, incredible. This is mind-boggling. 9 companies on the top 20 list were also in the list in 2010. So Apple, Microsoft, Alphabet, Google, in brackets, JP Morgan, JJ, Walmart, Nestle, and Exxon. Then they've got this interesting little animation here, which I think is really interesting, for the largest capital markets over the last 10 years. And if you look at this, it's really quite cute. If we go in here, just to make this a little bit smaller so you can see it, I really quite like this. If you watch this, you can see literally who got bigger and bigger and bigger. And of course, Apple got bigger and bigger and bigger. Certainly Microsoft got bigger and bigger and bigger. And Google. So quite interesting. If you go way back here, you can just literally see the change, which I think is a very interesting chart in itself. So then you've got the best performing S&P stock, S&P 500 stock over the last decade. And lo and behold, we see that it's Netflix, and Netflix were basically up a whopping 3,655%. And then you've got Market Access, and then you've got other ones going forward down. So pretty incredible returns, I have to say. Absolutely incredible returns. A lot of the other companies there I don't know, but certainly Netflix has done incredibly well. So now they're also saying, right, Netflix performed better than anyone else in the S&P 500, 37 times better in the last 10 years. And the second best stock is less of a household name, which is Market Access, which is an electronic trading platform for bonds. Wow. And Amazon didn't make the list. So if you look at the largest mutual funds, they've got PIMCO. Basically, PIMCO was there in 2010. Now they're not there. You've got Vanguard being the top now. You've got Fidelity. Now, Fidelity's come from nowhere. And keep an eye on Fidelity because they do a lot in cryptocurrency land. They're the ones to watch. Seriously, they're doing custody in cryptocurrency land. They've got a cryptocurrency desk, and now there's some talk that they're going to go into an exchange traded market and even maybe set up an exchange as well. American Growth Fund and Vanguard. So there's been a lot of changes in the last 10 years. I just wanted to bring that to your attention because I think this is a very, very interesting chart. So basically interesting data that's been put together. So seeing dramatic changes in asset management and styles. Obviously, PIMCO dominated with the Total Return Fund, but that's changed now to Capital Group, American Funds, and Vanguard. And Vanguard pretty much invests in the index. Okay, it doesn't take great big positions against the index. It basically invests in the index. So just want to bring that to your attention. I think this is very, very interesting indeed. I hope you get something out of this. This is education only, not financial advice. Thanks very much for listening, and I'll be back soon. Thank you. Also, guys, this is a disclaimer. I don't give any financial advice. This is just for teaching only. You need to look at your own information, your own risk tolerance. I'm not a